So you're new to investing and you stumble across the financial metric that usually people learn about, PE ratio. And you think anything over 20 is ridiculous and anything under 10 is amazing value. Well, you could be completely off, and in both circumstances, you could be completely wrong. So in this video, I'm going to go over what PE ratio is and a better way to utilize that financial metric through using another financial metric known as the PEG ratio. First off, the PE ratio, or price to earnings ratio, is essentially just share price divided by earnings per share. And to arrive to earnings per share, it's just net income minus preferred dividends divided by the shares outstanding. Another way to think about price to earnings ratio is how much someone is willing to pay to get $1 of earnings. So if there's a price to earnings ratio of 20, that means that you're paying $20 to get $1 worth of earnings from that company. So if we look at a company like Amazon, their PE ratio is currently 96.26, which would simply be the price of the share divided by the EPS. So with a PE ratio close to 100, you'd obviously never invest in a garbage company like Amazon. I mean, Jeff Bezos, who's that? I don't know. Who cares about Amazon? And that's the first problem with the PE ratio, is the fact that it doesn't factor in growth. So with Amazon, which is a faster growing company, it doesn't make as much sense to look at something like PE ratio, which is a backward looking financial metric. Something else to consider with the PE ratio is that it doesn't factor in one-time expenses or one-time bumps to earnings. So with Facebook, this is a good example. Back in 2019, the Federal Trade Commission imposed a $5 billion penalty on Facebook. So when we take a look at Facebook's second quarter earnings, you can see that there's actually a huge expense and what looks like a terrible quarter for Facebook. But in reality, if you take out that one-time expense, they were actually doing pretty well. So because of that, if you were looking at the trailing 12 months PE ratio for Facebook during that time, it would have shown that the PE ratio was terrible, when in reality, that one-time expense would eventually come out and their earnings would grow once again. And the same thing can be said on the earnings side. Let's say a company changes their accounting policy of the useful life of their equipment from 3 to 5 years. All of a sudden, they'll see more earnings because their expenses are going down because the depreciation isn't as big each year. So something like that can actually inflate the earnings per share, and something that you need to be paying attention to as well. Then on the flip side, you have the PE ratios that are extremely low. Now, any of these stocks under 5 are obviously just free money, right? Well, you can also have some underlying issues with the business that are kind of hidden. So let's take a look at a company like Big Lots. Now, I took a look at Big Lots for the past couple of years, and it has been trading at a lower multiple. Now, there isn't necessarily anything wrong with that, but if it's consistently low, there may be an underlying issue that's just not apparent. So if we look at 2019 and the net income, it was $156 million. Yet if we look at the cash flow statement, you can see in 2019, they actually lost $142 million when it comes to free cash flow. So their net income doesn't necessarily tie up with their free cash flow generation, which is kind of a red flag. And the company's been using cash over the years to buy shares back, meaning that they can inflate the earnings per share of the company without actually growing the company itself, whether that's the top line or bottom line. Fantastic. So the PE ratio doesn't factor in growth, it doesn't factor in one-time expenses or earnings bumps, and then also earnings can be manipulated on a short-term basis and kind of hide the fact that there's something going wrong. So what do we use instead of the PE ratio? One way to incorporate the growth aspect is using the PEG ratio, which takes your PE ratio divided by the earnings growth rate. And this allows you to see whether or not that PE ratio is crazy based on how fast that company's growing. Back to Amazon, which had a higher PE ratio. If you look at the PEG ratio, it's at 1.2. Anything around 1 is considered fair value. And so when we take a look at Amazon again, but from a growth aspect, the PE ratio doesn't seem insane. Well, thank God, because I am invested in Amazon. Jeff Bezos, take me to the moon. Now, the one caveat with the PEG ratio is what are you using as the growth rate, and is it reasonable? So usually for me, I use the 5-year EPS growth rate, And on Yahoo Finance, it's using a 32.8% growth rate. Now, the PEG ratio doesn't solve the issue when it comes to manipulating the net income on a short-term basis or playing around with accounting policies. The only way to really see how the business is doing without all of that accounting mumbo jumbo is to look at, you guessed it, the free cash flow. So instead of using the PE ratio, you can use something like the free cash flow yield, which is simply the free cash flow divided by the market cap, which for Amazon comes to be around 1.63%. So the higher that percentage is, obviously the more value that you're getting out of that investment. With Amazon, one caveat is that they do invest a ton of their cash back into the business. So you can see with their capital expenditures, around $24 billion, they're investing back into the business to get high returns down the future. So they're a company that invests heavily into innovation. Hopefully your takeaway from this video is that you need to look at different ratios and not just the PE ratio, because there are pros and cons to it. So if you're looking at a company like Amazon and it has a lot of growth, the PEG ratio is something good to look at. If you're a value investor and you're investing in something like Intel, the free cash flow yield may be something good to look at. Essentially, depending on your risk tolerance as well as what company you're investing in, you want to tailor your financial metrics that you're looking at. So overall, there's pros and cons to the PE ratio. That's why you want to look at more than just one thing. I hope you guys learned something in this video, and if you did enjoy this video, please consider giving a thumbs up and subscribing to Main Street Wolf. Thanks guys, and have a great day.